Gold falls below $5,000 as Asian holiday closures. Thin trading. Gold prices slipped below the psychologically important level of $5,000 per ounce in global bullion markets this week, weighed down by unusually thin trading conditions linked to holiday closures in major markets, and a firming U.S. dollar that dented investor demand for the precious metal. Spot gold, the benchmark for physical bullion, briefly traded under $4,950 per ounce before stabilizing near the key mark, reversing part of the recent gains it had registered in late January and early February. The retreat in gold follows a period of extraordinary price volatility earlier in the year. In late January, bullion surged to a record above $5,595 per ounce, amid robust speculative buying, investor inflows into gold-linked funds, and a general flight to safe assets during episodes of global economic uncertainty. However, that sharp upswing was followed by a rapid correction as profit-taking intensified and speculative positions unwound. This week's fall below $5,000 came against a backdrop of thin market liquidity, a common phenomenon when major exchanges shut for holidays. Large parts of Asia, including key trading hubs in China, Hong Kong, South Korea, Singapore, and Taiwan, were closed for the Lunar New Year holiday, while U.S. markets remained shut Monday for President's Day. With two of the largest global economies simultaneously out of the market, trading volumes in gold thinned significantly. That meant even relatively modest selling pressure could push prices lower, as fewer participants were present to absorb trades. Analysts noted that holiday-induced low liquidity often exaggerates price moves. When only a fraction of regular traders are active, small orders can have outsized effects on prices. In this case, subdued participation amplified the impact of bearish flows and profit booking, contributing to gold's slide under the $5,000 level. Another important factor behind gold's weakness was the strengthening U.S. dollar. Because gold is priced in U.S. dollars internationally, a stronger dollar makes bullion more expensive for holders of other currencies, reducing foreign demand. Over the past trading session, the dollar index, which measures the greenback's value against a basket of other currencies, climbed, putting further pressure on gold prices. The interplay between the dollar and gold is a familiar dynamic in financial markets. When the dollar rises, gold tends to fall, and vice versa. Traders often pivot to the dollar during times of uncertainty or when expectations for U.S. interest rates shift, as higher yields or firmer interest rate expectations tend to support the dollar relative to non-yielding assets like gold. Market expectations around the future path of U.S. monetary policy also shaped investor behavior. Recent U.S. economic data has sent mixed signals. Inflation readings showed a modest rise, yet job growth was stronger than anticipated, complicating forecasts about whether the Federal Reserve will cut interest rates this year. While lower interest rates generally benefit gold by reducing the opportunity cost of holding non-yielding assets, uncertainty about the timing and magnitude of future rate cuts has led some investors to adopt a cautious stance. Traders were also engaging in profit-taking after a notable rebound in gold prices late last week. Following a rally spurred by softer inflation data, some market participants were willing to lock in gains, particularly with markets thinly traded, further contributing to selling pressure. Analysts describe this as a normal correction after a period of rapid speculative advance. Despite the short-term slide, many market observers caution that the drop below $5,000 may be transitory. Several major banks and financial institutions maintain bullish long-term views on gold, noting that broader macroeconomic drivers remain intact. Persistent geopolitical tensions, questions about the independence and future direction of central bank policy, and a general shift among some investors toward hard assets have been cited as structural supports for gold prices in the medium to long term. Moreover, the underlying demand dynamics, including physical buying by central banks and continued interest from gold-linked exchange-traded products, continue to support the precious metals appeal, suggesting that the recent dip should be seen in the context of broader market cycles rather than a fundamental collapse in sentiment. From a technical perspective, analysts observe that the $5,000 level serves as both a psychological and technical support, meaning that prices often gravitate around such round figures as traders set entry and exit points. Breaking below this threshold can trigger additional selling if confidence is shaken, but it can also attract buy orders if investors see the drop as a buying opportunity. It's also worth noting that gold's usual role as a safe haven asset, an investment perceived to retain value during economic uncertainty, can see periodic tug-of-war dynamics between its risk-off appeal and other assets. When markets are calm and risk appetite returns, gold sometimes underperforms compared with stocks or riskier assets. This week's environment, with markets trading quietly due to holidays and limited catalysts for large price swings, accentuated short-term selling rather than driving safe haven demand. In addition to gold, other precious metals experienced weakness in the same session. Silver, platinum, and palladium also saw declines as thin liquidity and dollar strength affected broader commodity markets. Looking ahead, attention in the gold market is focused on upcoming economic data releases and central bank communications. Investors will be closely watching U.S. inflation figures, employment reports, and minutes from the Federal Open Market Committee, FOMC, meetings for clues about future rate decisions. Such data could influence the dollar and, in turn, gold prices once trading activity returns to normal levels following holiday closures. In summary, gold's recent dip below $5,000 reflects a combination of low trading volumes due to Asian and U.S. market holidays, a stronger dollar, short-term profit-taking, and mixed monetary policy signals, all contributing to a temporary pullback in prices. While the move has attracted attention due to the symbolic importance of the $5,000 threshold, many analysts view it as a short-term fluctuation rather than a reversal of the longer-term upward trend in gold markets.